Good evening, everybody. My name is Joe Werther, and I'm Senior Lecturer in Accounting here at Georgia Southwestern State University. And tonight I want to continue my discussion of Chapter 18. In the text, your exam is the weekend of October 20th and 21st, and probably 20 out of the 35 questions on the exam are from Chapter 18. So Chapter 18 is a really important chapter. With my last video, I kind of covered the beginning of Chapter 18, but tonight I want to continue with Chapter 18 and hopefully give you some insight of what the whole chapter, or what most of the chapter, is about. Okay, now I've put up here two different types of income statement format. This is the format that you learned in Accounting 2101. Sales minus cost of goods sold is gross profit minus selling and administrative expenses is operating income. Okay, here's the new format that you learn in Accounting 2102, managerial accounting. What we do is we break out all variable costs and all fixed costs. Okay, and I mean every fixed and variable cost. For example, in variable cost, that not only includes direct materials, direct labor, and variable manufacturing overhead, but it also includes variable selling and administrative expenses. Okay, fixed costs includes fixed manufacturing overhead and fixed selling and administrative expenses. Okay, so you can kind of look at this income statement and you can say, okay, cost of goods sold contains both variable and fixed manufacturing expenses, and the selling and administrative expenses for this type of income statement contains both variable and fixed selling and administrative expenses. So this segregates variable and fixed cost. Okay, now that's all I want to say about the two different types of income statements. There may be one question on the exam which maybe gives you this type of income statement and wants you to figure out, say, contribution margin or operating income. So what you got to remember is when you go from this type of income statement to this type of income statement, you want to break out all your variable costs and put them right here, and all your fixed costs and put them right here. And that's how you're going to get the operating income. And by the way, operating income will be the same under both types of statements. Usually the problems on the test will have you designate what contribution margin is, which then you're going to have to pull out all the variable costs from this type of statement and put them here where variable costs are to get your contribution margin. Okay, so it's sales minus variable cost equal contribution margin minus fixed cost equal operating income. That's the income statement that we're going to be dealing with for the rest of the semester. Okay, now, from that income statement comes a lot of formulas, and that's where most of my students seem to have a problem with, is applying formulas from this income statement format. Now, let me just show you something about the income statement before we start talking about formulas. We measure units, unit price, and total dollars, okay, when we use this type of income statement. Now, here's one thing to remember. If any of these three items, sales, variable costs, or contribution margin, if any of them are a number, such as sales is 100, all three of them are 100. And that's one thing you really got to put in your mind. If contribution margin is 100 units, variable cost and sales have to be 100 units. Okay, if variable cost is 100 units, contribution margin and sales have to be 100 units. All three have to be the same. Okay, now I'm just putting in some fictitious numbers here. Okay, these are unit prices, and these are total dollars. This amount is total dollars. Okay, so 100 times 10 is $100, 100 times 4 is $40, 100 times 6 is $60. Okay, if we want to know the contribution margin ratio, we can figure this out either using unit prices or total dollars over here. Either one. And all we got to do is take the contribution margin over the sales price. Either way, you can figure out the contribution margin ratio. It's contribution margin divided by sales price. And of course, the contribution margin ratio here would be 60%. Now, if the contribution margin ratio is 60%, the variable cost ratio has to be 40% because everything, both variable cost and contribution margin, have to equal the sales. Okay, so the sales then is 100%, 4 over 10 is 40%, and 6 over 10 is 60%. So keep in mind, a lot of problems will ask you to figure out, you'd have to figure out the contribution margin ratio. And the contribution margin ratio is no more than the sales price over, the contribution margin unit price or total dollars over the sales unit price or total dollars. Keep that in mind, okay? Because that's an important equation or ratio that you have to know, the contribution margin ratio. Now, from this type of income statement, we also have what's called break-even analysis. Okay, and you can find out break-even in units by putting fixed cost over the contribution margin unit price. Okay, break even in units, fixed cost over the contribution margin unit price. Okay, now let's just put a number in here for fixed cost. Let's put $20 in for fixed cost. Okay, so what did we make? 60 minus 20, we made $40. Okay, so if we wanted to figure out the break even in units of sales, we would take the $20 over 6. That's the unit price. 20 divided by 6. And that would give us the break even in sales units. Now, if we want to find out break even in total dollars, all we have to do is change this, the denominator, to the contribution margin ratio. The contribution margin ratio. So essentially what this would be 20 over 60%. Okay? 20 divided by 60%. That would give us break even in total sales dollars. Now, you can expand these break-even equations or ratios to include desired profit. Like, for example, if you get asked in a problem, how much money or how many units do we have to sell, or how many dollars do we have to sell to make this amount of money? Okay. Now let's say you get a problem that says, how many dollars do we have to sell to make $100 of operating income? Well, in this case, all you would do would say 20 plus 100 over the contribution margin ratio. Now, if you wanted to know how many units you had to sell, okay, to make $100 in income, you would take fixed cost over the contribution margin per unit. So with this break-even analysis, you can expand the break-even ratio to include desired profit. So yes, it's 4 different ratios, but really what you have to remember is anytime you're talking dollars in sales, you're going to use the contribution margin ratio for the denominator. And if you're talking units in sales, you're going to use one of the unit prices for your denominator. So by applying those ratios, you will solve a lot of the problems that I've handed out. If you go out in GoView, you'll see, I think, 4 sets of problems out there. 2 or 3 sets are from chapter 18, and I believe 1 set's from chapters 17. But a lot of them have to do with those 4 formulas, and you must have this type of income statement memorized, because in many of the problems, you have to set up this type of income statement format. Now, let me just go through another formula that you need to know from chapter 18, and I'm sure you'll see a couple questions on this. It's called the margin of safety. And that formula is budgeted or actual sales minus break-even sales. Okay, budgeted or actual sales minus break-even sales. Now, if you think about it, the margin of safety is really the difference between the budgeted or actual sales and the break-even sales. It's the amount of sales that you can start losing until you get all the way down to break-even sales. You can still make money. You're going to make less and less money, but when you get to break-even sales, you won't make anything. So it's this like padding between the budgeted and actual sales and the break-even sales. They call that the margin of safety. Now, if the problem asks for margin of safety as a percentage, just take your margin of safety amount, the difference between budgeted and actual sales and break-even sales, and put that over the budgeted or actual sales number. Okay? So that's margin of safety divided by budgeted or actual sales gives you the percentage of margin of safety sales. Okay? Because you may get asked in a problem, what is the percentage? They call it margin of safety percentage. Okay? If you get asked margin of safety percentage, you got to figure out margin of safety first. And then you just take whatever the margin of safety is and you put that over the budgeted or actual sales. Okay? So those formulas are pretty much all the formulas you'd have to know, or you have to know for chapter 18, and really you get used to these formulas by just doing these multiple choice over and over, and that's the whole key to this test. You got to do these multiple choice over and over to really learn the formulas, because once you start doing that and you do the self-test at the end of each chapter, you do those problems over and over, you just learn the formulas. I mean, it just becomes second nature. And when you see these test questions, which are very similar to the questions in GoView, you should be able to answer those questions with no problem. Now, let me just take one of the multiple choice questions, one or two of them, and just go through it with you. Let's look at this one handout that I gave you. The first question, it says, at its $25 selling price, Piccololi Company has sales of $10,000, variable manufacturing cost of $4,000, and fixed manufacturing cost of $1,000, and variable administrative selling cost of $2,000, and fixed selling cost of $1,000. What's the company's contribution margin per unit? Okay, well, we don't have to worry about anything below contribution margin. Okay, that's all we have to worry about is above fixed cost, because they want to know what's the contribution margin per unit. So let's just put some of the data down and let's see if we can't figure it out. Okay, at its $25 selling price, they have sales of $10,000. Okay, so you have a $25 selling price and you got $10,000 in sales, total sales. Okay, now right away, I can take the $10,000 and divide it into 25, and let's do that. And that will give me 400 units that were sold. Okay, so that means variable cost is 400 and contribution margin is 400. Okay, so now let's look and see what the total variable costs are. Okay, variable manufacturing costs are 4,000. Okay, so this is 4,000. Okay, and variable selling and administrative cost of 2,000. Okay, well, let's do this. 4,000 plus 2,000. Okay, so that appears to be all the variable costs in the problem. Okay, so let's add these two together. 4,000 plus 2,000 is 6,000, and let's subtract them from the 10,000. So 6,000 from 10,000 is 4,000. Okay, so 4,000 total dollars is the total contribution margin. Sales were $10,000, total fixed costs are $6,000, total contribution margin is $4,000. Okay, so now, can we figure out unit price for contribution margin? Certainly. 4,000 divided by 400 should be 10. Okay? 6,000 divided by 400 should be 15. 25 minus 15 is 10. Okay? See how simple it is if you just understand this format and how this all works. Units are all the same. Once you get one, all three of them are the same. And so they gave us the lump sum of sales, and we can figure out, they gave us unit price of $25. So we were able to figure out, we divided 10,000 by 25, and we got 400 units. Okay, and once we got that 400 units, we could say, well, variable cost and contribution margin are each 400. And then we just added up our variable costs, all our variable costs, and we came up to 6,000. And lo and behold, our total contribution margin was $4,000, and we had 400 units. So the unit price, which is what they're asking for, is $10. Okay, so that's one demonstration of how this format solved that problem. Okay, now let's take another look at a different set of problems. And let's see let's see what we can do with this problem. Okay, this is a problem number 42. It starts with CMA Incorporated produces a product that has a variable cost of $250 per unit. Okay, and I'd set this format up on my piece of scrap paper when right before I'm taking the exam or right at the beginning of the exam. I would set this up so you have this all set up. Okay, so let's put these numbers in. Product has a variable cost of $2.50 per unit. Okay, the company's fixed costs are $30,000. Okay, there's $30,000. Okay, the product is sold for $5 a unit. Okay, and the company desires to earn a target profit of $20,000. What amount of sales will be what amount of sales that will be necessary to earn the desired profit? Okay, well, what are we going to do first? Okay, what did I tell you the desired profit formula is? Fixed cost plus operating income. Well, okay, right away now, if we have $5 minus $2.50, we can say that contribution margin is $2.50 per unit, right? Okay, now, anytime we want to know an answer in dollars, we got to figure out the ratio, the contribution margin ratio. So let's take $2.50 and let's put it over $5, contribution margin divided by sales, and that gives us a ratio of 50%. Okay, so what's our formula? Fixed cost plus desired operating income over contribution margin ratio. Okay, so fixed cost plus desired profit of $20,000 over 50%. Okay, so what do we have? 30,000 plus 20,000 is 50,000. $50,000 divided by 50%, actually what this says is $50,000 is 50% or 1/2 of some number. What number is that? Okay, $50,000 is 1/2 of $100,000. Okay, that's actually what that says. So if you look at your answer is D. Okay, now I hope, by demonstrating, how important this format is and how important the formulas are to know, that you get an idea now about what to do or what you're going to see on the exam, because these are the kind of problems that you're going to see on the exam. Now, you will see some theoretical questions. Questions like, well, if I lower sales price by this much and I raise variable cost by this much, what's it going to do to break even? Okay, just make yourself little diagrams. Sales minus variable cost equal contribution margin. Put numbers, put fictitious numbers like 10 minus 5 equals 5, and then lower sales price 1, 9, raise variable cost up 1 to 6, and new contribution margins 3. Okay, do it like that, and your fixed cost, you'll have a solid number for fixed cost. So you can take your fixed cost and put it over the original contribution margin, and and then compare it to putting it over the new contribution margin, and you will be able to see what happens to break even. I mean, I'm not going to stand here and tell you what's going to happen to break even, but I will tell you how to solve a problem like that. And I always just use fictitious numbers, like I may go 10 minus 5 is 5. Okay, lower sales price by 1, raise variable cost by 1. Okay, 9 minus 6 is 3. Okay, what's the new ratio 5 to 10, this is 50% original ratio. 3 to 9 is 0.33. New ratio, okay, so the ratio dropped, okay, and a fixed cost are $100,000, okay. $100,000 is 50% of $200,000, okay, so break even would be $200,000, okay, and then $100,000 divided by 3333, $100,000 is 33% of $300,000, okay, and this is a good example. And so what happened to break even? Break even went up. Yeah, sales price came down and variable cost went up, break even went up. And that's a good way to solve those kind of theoretical questions that you see on the exam that you might not know right offhand. Now remember, this exam's about reading. Not only do you got to know the formulas in this income statement format, but you have to read the question. If they're asking for contribution margin in a question or contribution margin ratio in a question, just take it to contribution margin. Don't go down to operating income. If they're asking for the profit, then you got to go down to operating income. Now, if they're asking for the difference, you've got to look at the original and you've got to look at the new, and you've got to compare the new with the original, and the difference is what it either increased or decreased. So it's very important to read the question. I tell everybody, read what is being asked first, because in a lot of these questions, there is numbers, or there are numbers that are irrelevant to what you really need to use to solve what's being asked. Okay, I hope that I helped you tonight. This concludes my video on Chapter 18. I don't think I'm going to have a video on Chapter 19. What I'm going to do is I'm going to put an announcement out there of what exercises you need to work out in Chapter 19. There's only going to be maybe 5 or 6 multiple choice questions from Chapter 19, and I'll label the exercises that you need to work out in Chapter 19, and you'll have the solutions, or you do have the solutions out in GoView. So you can work those exercises and look at the solutions, and that should be enough to answer any questions that are put on the exam from Chapter 19, because Chapter 19 is basically just an extension from Chapter 18. That's basically what it is. The only new concept in Chapter 19 will be multiple product break even. Multiple product, okay? In Chapter 18, we just assumed one product. In Chapter 19, there's multiple products. Okay, so that'll be the new, the only thing new in Chapter 19 really that you have to know. Now I may change my mind. If I look at Chapter 19 next week, I wasn't planning on doing a video, but I may change my mind if I look at it real close, and I may do another video for you. But anyway, take this information that I've given you tonight, and please do as many multiple choice as you can, and do them multiple times, because that's the only way you're going to get used to using these formulas. Thank you very much.